Welcome to Capital Connections, where the complex world of finance becomes approachable, practical, and ready for your entrepreneurial journey. Hosted by Lorette Ferris, the Capital Coach, a seasoned financial services thought leader who has journeyed through investment banking, mergers and acquisitions, business brokerage, and crowdfunding. This podcast is our way to give back. It's our gateway to help demystify your business growth pillars. Each episode is part of our three-tiered multifaceted business lifecycle journey, training series, growth by acquisition, getting investor ready, and exit on your terms. It all starts with our Capital Navigators blog, where each episode is converted here in Capital Connections for those who choose to listen instead of read. Now, we don't stop there. We dive deeper into each topic through self-paced coaching programs, masterclasses, and mastermind groups, transforming this information into action steps for those seeking more. Speaking directly to solopreneurs, micro to small businesses, transitioning corporate executives, and technicians. Our approach? Simple yet profound. We break down high-level financial concepts into everyday language, making them accessible and actionable. Whether you want to acquire a business, raise capital, or sell your company, plug into our Business Lifecycle Journey series. So, tune in, turn up the volume, and get ready to connect the dots in your financial journey. Let's begin.
Preparation is key, getting your business ready for a profitable exit. Essential steps to prime your business for the market. After pouring your soul into building a business, deciding when and how to exit is no small feat. As a seasoned mergers and acquisitions advisor, I understand this pivotal move requires emotional readiness and shrewd planning to reap full rewards. Preparation is the cornerstone for maximizing value when your enterprise's long anticipated day-to-day transition finally arrives. With so much personal equity invested in the venture, many owners struggle to objectively assess their company's worth and the best next steps. The suitors are poised to steward their life's work respectfully, where an advisor plays a clarifying role. By proactively optimizing operations, clearly articulating growth potential, and transparently addressing vulnerabilities, enterprises become investor-ready well before engaging potential acquirers, establishing leverage in negotiations, aligning owner interests, and driving premium offers that reflect the tangible and intangible value crafted over years of dedication. This preparation unlocks liquidity that rewards rather than discounts owner sacrifice. This premature journey into the unknown may initially feel daunting for small business owners weighed down by exit complexities. But by meticulously priming your enterprise and timing market conversations shrewdly when the pieces are perfectly aligned, you can navigate ownership transitions smoothly, benefiting from financial interests and legacy. Your venture and livelihood deserve nothing less than the most thoughtful approach when that faithful day arrives to pass the baton, rewarding your entrepreneurial spirit richly on the way out. For enterprises that have been exit planning. For entrepreneurs who have spent years thoughtfully shaping transition strategies, pat yourself on the back. You stand poised to capitalize on the fruits of this prudent planning. Still, even the most future-focused owners reaching the precipice of liquidity stand to gain from final preparatory moves. As a specialist guiding small business exits, I always remind clients with long lead times on eventual transactions that sustain optimization and measured patience truly amplify outcomes. The buyers most compelled by enterprises nurtured for acquisition value discipline and commitment to vision as much as current financial results. They seek ventures whose leaders focus on profit generation for themselves today and profitable growth for partners tomorrow. With an eye always on the horizon and stewardship transfer on top of mind, these owners invest in scalability and management continuity long before exit conversations commence, which makes transitions seamless while unlocking maximum return potential. If having meticulously laid sale groundwork over the years, stay the course through sustaining revenue expansion, continue targeting 10 to 30% annual growth by penetrating adjacent segments or expanding services, prospective advisors on untapped pathways, continuously escalating profitability signals, enterprise health, and hands buyers a blueprint for accelerated expansion. Also, retaining and developing managers. Give rising leaders incremental authority before they have a flight risk. Institutionalize knowledge and clear succession planning give buyers confidence in continuity post-acquisition. Look to exploring alternate liquidity options. Engage merger and acquisition specialists to stress test existing acquisition assumptions. Savvy owners entertain diverse deal structures and partners to unlock value. However, they only transact once, finding the best avenue aligned with legacy and financial interests. For those playing the long game, patience and discipline at the end, it allows you to line and allow you to both time transitions perfectly. And exploring alternate liquidity options. Engage with merger and acquisition specialists to stress test existing acquisition assumptions. Savvy owners entertain diverse deal structures and partners to unlock value. However, they only transact once. So finding the best avenue aligned with legacy and financial interests. For those playing the long game, patience and discipline at the exit line allow you to both time transitions perfectly while attracting premium offers from buyers compelled by that commitment to deliberate growth. The enterprises that have not planned for their exit. For most entrepreneurs immersed in daily fires, exit planning remains a distant priority that gets continuously pushed down the road. I empathize wholeheartedly. In the urgent marathon of scaling our passions, thoughts of one day bequeathing our life's work to unknown stewards simply overwhelms us. But even if the prospect of strategically transitioning your business currently feels premature, it is prudent to intermittently assess what levers you can pull to prime your enterprise for a rewarding eventual sale. Think of exit planning not as prematurely relinquishing your baby, but rather as a forced evolution exercise, one where you step back and ask, how would an acquirer evaluate this organization if I were no longer in the picture? What vulnerabilities or dependencies would raise flags or depress the value? This simple thought experiment yields a roadmap for enhancement initiatives that deliver dividends regardless of timing. Steps like institutionalizing operations, document the processes, and implement enterprise systems to reduce reliance on the owner's tribal knowledge. Professionalizing finances, hire accounting support to clean up reporting and provide insights into capital allocation, profit drivers, and scalability dynamics. Formalizing management. Develop a leadership pipeline to preserve institutional knowledge. Define roles not dependent on the founder to illustrate continuity. By proactively building enterprise maturity in these areas over 12 to 24 months, you signal prospective buyers that your business can operate smoothly without you, dramatically expanding your universe of potential acquirers willing to pay full value while making leadership transitions seamless by design. While most owners do not proactively exit plan, it is never too late to pull levers that professionalize operations, talent, and financial reporting. Savvy acquirers explicitly target enterprises with their houses in order, even if the planning started later in their life cycle. Priming your company for sale. Once the decision emerges to someday transition your business, the most common question is, what must I do now to both time and maximize this pivotal liquidity event? My guidance focuses on a 6 to 18 month optimization runway called the investor readiness phase, which stretches from the point of quietly retaining a transaction advisor to when marketing materials first reach potential acquirers. These precious months allow you to implement enhancements that dramatically expand the investor pool willing to pay premiums while smoothing subsequent leadership transitions. We distill readiness down to 4 critical areas enterprises must amplify to prime for attractive offers. First, there's institutionalized operations. By documenting the processes and systems to diminish reliance on tribal knowledge, you demonstrate the ability to hum post-close with new stewardship. Next, there's trustworthy financial reporting. Cleaning up historical financial accounts and providing forward-looking benchmarks quantifies growth trajectories to underpin valuations. Next, visionary growth narrative. Articulating addressable market size, competitive differences, and a product roadmap that spotlights upside potential beyond current revenue. And then there's owner-independent talent. Retaining and better leveraging critical managers preserves institutional knowledge while signaling continuity. Entrepreneurs illustrate the drivers and markers underpinning a forecast valuation by focusing on progress across these areas during the investor readiness phase. This primes enterprises for fruitful exit dialogues rooted more in opportunity than historical gains. Underestimating the importance of preparation introduces unwanted turbulence and leaves transactions outcomes misaligned with reality and expectations. However, owners who implement methodical readiness plans years or months in advance find themselves better positioned to maximize value while matching with owners who respect their life's work. Patience and discipline at the outset provide the keys to a graceful finish. Proactive steps to prime your business for sale. Charting a course for the optimal ownership transaction aligning legacy and financial interests requires diligent preparation. I've distilled the most pivotal readiness steps enterprises must amplify to prime for transition, forming the bedrock companies stand upon when meeting prospective acquirers. In the following sections, we explore these essential initiatives to implement during the 12 to 18 months prior to engaging the market. While preparation demands patience, Owners who lay their groundwork methodically can exit lucratively and purpose aligned when the time comes to pass that baton. Financial readiness, which is the North Star to guiding value. For prospective acquirers assessing a potential investment, the foremost question asked is, does this business demonstrate the ability to generate and, importantly, sustain significant profit over time? Before even considering market potential or continuity planning, buyers fixate on historical financial reporting to benchmark scalability, growth trajectories, and overall enterprise health, and in that order. Yet, amidst the daily fires demanding an owner's energy, financial hygiene often slides down the priority list, mainly if operations primarily function off tribal knowledge rather than modern analytics, which is why in the 12 to 18 months prior to engaging the market, it becomes mission critical to refine financial accounts, providing investors a calibrated compass guiding the valuation discussions. Specific priorities include retaining a finance specialist, tap external accountants to clean up reporting and implement insights-led planning. Their injection of rigor and benchmarks establishes credibility. Targeting a 10 to 30% revenue expansion. Focus innovation and investment towards products, services, and segments demonstrating consistent expansion at this trajectory over a 3+ years. Maintaining profit margins. While scaling rapidly, keep delivering consistent profitability, showcasing the ability to grow faster than costs. Vetted financials serve as the North Star guiding value conversations by quantifying an enterprise's momentum and potential, determining whether acquisition talks open productively or stall fruitlessly. By proactively putting your fiscal house in order well before engagements, you set the stage to navigate discussions from a position of strength. Institutionalizing operations before financial reporting, prospective buyers fixate on whether a business demonstrates resilience beyond current leadership capabilities. They ask, if the founder or CEO left tomorrow, would operations grind to a halt? Highlighting the urgency during readiness phases to build enterprise maturity, insulating companies from overdependence on tribal knowledge. Yet, with competing priorities pulling the owner's attention in a myriad of directions, few dedicate precious time towards documentation and succession initiatives until a transaction looms imminent. The precise reason is that institutionalization becomes essential well before sales explorations ever commence. By demonstrating the ability to function seamlessly, irrespective of existing stewardship, enterprises illuminate growth pathways possible under a new direction, retaining and expanding value. Here are some specific priorities to include: documenting processes. Outline procedures, workflows, guidelines, and resources relied upon daily that live off of the cuff. Delegating incrementally. Entrust managers with discrete responsibilities and authority that deepen bench strength. Identifying and mitigating risks. Highlight operational vulnerabilities requiring insulation to anchor company resilience. Implementing modern systems. Transition from market shift tools prone to disruption towards enterprise platforms and analytics providing continuity. By taking an investor's perspective of his operations through a continuity lens, an owner can preemptively build enterprise maturity, sustaining growth well beyond his tenure. Legal and compliance diligence. Buyers, understandably, also fixate on legal exposure risks that could financially or reputationally disrupt enterprise momentum post-close. Scrutinize agreements, partnerships, product specs, and personnel policies through a liability lens, asking what latent vulnerabilities or non-compliance issues exist that could undermine our investment. Even for promising targets, discoveries during due diligence frequently cause deals to collapse, highlighting why utilizing readiness phases to undertake diligent internal audits serves such an essential purpose. By preemptively identifying and remediating legal oversights often buried over years of hypergrowth, enterprises signal an operation built to last beyond current leadership. Specific priorities include formalizing agreements. Ensure contracted partnerships, vendor terms, IP controls, leases, and staff arrangements are clear and binding. Vetting product guidelines. Verify complete adherence to evolving regulatory rules, requirements, and specifications. Assessing human resource policy gaps. Scrutinize handbooks, practices, and training against compliance standards and optimal protocols. By undertaking a robust legal review through an investor lens before conducting the same, sellers obtain leverage in negotiations while unlocking value, proactively showing reputational, financial, and operational integrity beyond just ownership transition, increasing marketability. Articulating your growth narrative. Beyond current financials, buyers worry about future upside potential. They want to know, based on addressable market size, competitive differentiation, and demonstrated trajectory, what revenue escalation runways exist beyond today's returns. Yet, amidst daily demands, few owners step back to comprehensively assess their total addressable market, right fit clientele, and sustainable advantages that outpace rivals. Without this introspection, conversations default to present day vanity metrics rather than visionary outlooks underpinning valuations, leaving money on the table. So it becomes essential to spotlight your enterprise's potential during preparation. This involves assessing adjacent expansion pathways and documenting competitive differentiation by showcasing windows of opportunity beyond the status quo. You provide acquirers a compass guiding their growth blueprint. Specific priorities include sizing your total addressable market. This is where you analyze the absolute revenue potential across current and viable adjacent products, segments, and geographies. Quantifying your competitive advantage, where you outline sustainable differentiators in brand, offerings, experience, channel presence, and predictive intelligence that position you as a market leader. Modeling a go-to market expansion roadmap. Plot specific milestones over 24 months, spotlighting how acquirers can rapidly escalate top-line returns through your established enterprise maturity. By proactively articulating your blueprint for scalability beyond current outputs, You attract growth-minded investors willing to pay premiums today for the privilege of stewarding expansion tomorrow. Management continuity. Beyond financial reporting and operations, buyers increasingly prioritize enterprise resilience and continuity risk in assessments, asking, will there be significant leadership turnover or talent losses post-transaction that undermine the momentum? This spotlight on human capital vulnerability has multiplied over recent years as owners exit without documenting institutional knowledge or grooming successor leadership pipelines. Disruption often follows despite best intentions. The precise reason is that having structured continuity plans in place well before engagements has become non-negotiable in priming for transition. By demonstrating sustainability, leadership infrastructure, and retention initiatives, sellers reassure prospective acquirers that talent-driving enterprise value will remain economically unified through changes. Such continuity provides a necessary catalyst ensuring successful continuity. Sellers obtain leverage in negotiations by taking an acquirer's perspective on human infrastructure scalability while unlocking otherwise overlooked value. This proactivity converts enterprise maturity into currency when engaging prospective acquirers. Elevating physical environments. In assessing acquisition targets, buyers consider quantitative dynamism behind outputs and more qualitative facets contributing to enterprise excellence over time. They seize on elements like workplace environment, storefront curb appeal, and accessibility accommodations as indicators of management continuity expectations and alignment to espouse human-centered values. While rarely budget priorities amidst scaling demands, these overlooked aspects become ransom opportunities under the scrutiny of social impact-oriented investors conducting diligence through an environmental, social, and governance, the ESG lens, asking, how have leaders invested in the inclusivity, sustainability, and accessibility of facilities where value originates? Enterprises without public storefronts benefit from previewing their physical spaces from this forward-looking perspective before engagements by considering incremental changes that mirror the type of workplace or retail environment they hope to be stewarded towards. Specific priorities include enhancing curb appeal, minor facade enhancements reflecting brand evolution yield outsized impressions on arrival. Improving accessibility, assessing and addressing structural impediments to workplace or retail access for differently abled patrons signals continuity priorities. Elevating sustainability, demonstrable renewable energy, waste diversion efforts, and green space preservation provide glimpses into the type of future facilities management envisions. By proactively progressing towards environments that embody enterprise values beyond profit pursuits alone, owners obtain leverage in negotiations while attracting premium offers from impact-aligned investors, compelled by such investments in continuity and conscious. Advisor alignment. Navigating the twists and turns spurred by ownership transition requires specialized expertise and objective insights serving as guides. Yet, amidst heavy workloads, Few business owners tap external specialists in the year leading up to engagements to help chart optimal pathways aligning legacy, value, and tax consequences. Instead, many rely on internal assumptions or advisor offers arriving too late to integrate the real preparedness benefits without raising risk red flags. The precise reason for proactively aligning 12 to 18 months out with an experienced suite of partners specializing in merger and acquisition navigation, legal diligence, tax efficiency, and finance proves so pivotal. Specific partners traditionally include merger and acquisition advisors. They help to position enterprises attractively while structuring engagements efficiently to maximize value. Legal partners, who conduct diligence to mitigate liability risks tied to agreements, IP, compliance, and personnel. Finance specialists provide transaction services assistance, including liquidity event modeling, deal financing, and cash management. By preemptively building expert continuity infrastructure through specialized partners, enterprises realize multiplier returns during executions, unlocking value no single internal owner can achieve alone. Preparing for due diligence. Before acquirers conduct extensive due diligence, examining a contemplated investment's financial, legal, tax, and continuity risks, they initially gauge diligence preparedness. They consider whether corporate records, data infrastructure, and personnel policies easily pass muster if scrutinized through a microscope evaluating organizational maturity. Yet few owners codify and centralize historical documents that live scattered across folders and platforms and filing cabinets to support rapid response to investor inquiries for easy access and deliverability. By demonstrating readiness through early document accessibility, sellers obtain leverage preempting the typical delays buyers experience through teeth-pulling requests during discovery. Specific priorities include centralizing key documents, consolidate contracts, financials, product specs, manuals, licenses, and insurance policies into easily accessible repositories. Vetting sensitive content proactively, verify personnel, customer, and partner records aligned to standards through a due diligence lens before questions emerge. Institutionalizing compliance digitization. Implement systems formally capturing and cataloging artifacts tied to obligations in real time. Essentially, enterprises accelerate pathway to liquidity by easing, expediting, and elevating outcome potential by undertaking diligent dry runs before acquirers ever knock. Signaling readiness to attract premium buyers. Implementing meticulous operational, reporting, talent, and narrative enhancements during a 12 to 18 month investor readiness phase is more than prudent preparation. It broadcasts a signal, one received loudly and clearly by growth-oriented buyers and private equity firms perpetually examining the market for acquisition targets primed for investment. These sophisticated stewards seek enterprises exhibiting enterprise maturity, institutionalized wisdom, and financial disciplines as ready for scalability, even if founders have yet to declare intentions to engage buyers openly. They fixate on ventures that drive profitability, expand market share, dominating niches, and implement platform infrastructures capable of rapidly integrating through acquisition. Yet despite strong financial outputs, many mid-market companies at inflection points fall short of drawing optimal buyer attention due to readily addressable gaps in process continuity, management stability, or risk management. This dynamic means modest investments in operational excellence, talent development, and risk containment before formally reaching out through intermediaries pays exponential dividends in buyer targeting without requiring a premature for sale label. Motivated buyers scout the market, seeking superbly managed companies with aligned ownership interests well before they ever engage in sales talk. Savvy entrepreneurs recognize that cultivating these attractive qualities signals acquisition viability regardless of the economic climate. Aligning patient preparedness with premium exit outcomes. Conclusion: prepare diligently, engage discerningly, steward respectfully. The decision to transition your purpose-built enterprise marks a seminal moment layered with financial, operational, and emotional intricacies only other entrepreneurs can fully appreciate. Yet, with so much personal equity concentrated in these assets, even founders ready to exit often struggle to objectively assess market signals, evaluate partners, and clarify ideal terms guiding legacy alignment. Overwhelmed best intentions lead down paths of misalignment. Still, for those who walk this path lucratively, a common thread emerges in their stories. At the outset, implementing meticulous preparation served as the prerequisite to engaging discerning buyers through win-win deal structures rewarding commitment to excellence. Their journeys and ultimate destinations hold lessons for leaders weighing what comes next for their organizations. The process requires patience bordering on stubbornness. Implementing readiness initiatives and optimizing value thoroughly before entertaining conversations constrained by existing operations. But for those enterprises putting in this work, the market responds accordingly. The buyers most compelled by small enterprises are students of business architecture seeking not just lucrative models, but also founders driven by purpose over profit alone. They understand transformation potential exists in visions, not balance sheets, and they are willing to pay premiums for the privilege of stewarding both. So, as the hourglass runs low on remaining opportunities, pause. Prepare diligently. Engage discerningly. Only transact once you attract stewards honoring legacies, communities, and opportunities built by your sacrifice. Your life's work deserves no less.
And that wraps up another enriching episode of Capital Connections. Thank you for joining us this week to navigate the ever-evolving landscape of business and finance. Your journey toward growth and success is our top priority. You can stay connected to our offerings by checking us out at ibossinc.net, subscribing to our Capital Navigators blog, following our company page on LinkedIn, registering for a masterclass, or joining a mastermind group. At Capital Connections, our mission goes beyond simply sharing knowledge. It's about crafting transformative experiences. So, until our next encounter, stay on the path of connecting the dots in your financial journey, and let's continue in our joint journey of growth, innovation, and leadership. Thank you again for tuning in, and see you in the next episode of Capital Connections.